In our previous sessions, we were talking about ESOPs. We get into some of the details and the pros and the benefits to ownership. And so you might be wondering, okay, there are pros and there also has to be cons in any type of transaction that you might want to enter. And in ESOPs, there's definitely pros and cons. Obviously, the pros relate to the fact that the owner of a post-sale company has an exit strategy. It's an exit strategy that is very simple. It allows them to know the shareholder that they're selling to. It allows them to be part of the corporation as they move forward. Because as you look through and you do the exit strategy with an ESOP, a lot of times the owners are part of the board of directors, so they sometimes become the chairman of the board. Sometimes they're just participants in that. So they become very active. There's usually an employment agreement that goes with an employee stock option plan as we started up. So that employment agreement allows the owner to stay involved for the next 2, 3, 5 years, whatever the actual company wants and the board of directors decide on. So there's a lot of benefits to them of knowing that the culture continues, that they know exactly what's going to be involved. They get to stay involved in the company, and a lot of times they're ready to sell, but they're not really ready to walk away and not have anything to do. So it allows them to be very involved and stay active and be involved in the day-to-day decisions. The cons of it are, that one, they have to wait for their money maybe a little bit longer than they would, especially in a private equity sale. In a private equity sale, a lot of times the company comes in, they offer you 80% of your money up front. They offer you 10, 20% of the value in overall shares within the company that's purchasing your company. So that gives you an opportunity to have money in the future, but you only get 80% of your money up front. And so that becomes a pro and a con when you're looking at that perspective. Another con is that usually when you get your money from a bank, because if the employees are buying the stock, obviously they don't have the money, so the company usually looks to an outside party, being a financial institution, to finance that transaction. Well, the bank's not going to let you take $10 million out of the company and then walk away. So they usually require you to be in a subordinated position. So in take a $10 million transaction, for an instance, $5 million of that may come from the bank, $5 million of that may come from you as a seller note. Well, that seller note becomes subordinate to the bank, so therefore you're going to get your $5 million of cash up front, where in a private equity transaction you might have gotten $8 million in that $10 million deal. So you're getting less cash up front, and you're going to have to subordinate your entire $5 million to the bank, which means you don't get paid until the bank is fully paid off. And then after that, you're sitting there in a situation where you're going to take that $5 million over some term, whether that's 3 years, 5 years, 10 years. So there has to be a little more patience for the selling shareholder in an ESOP transaction. They have to be willing to, quote, be at risk for a longer period of time than they would in a private equity situation. But at the same time, it allows them to take that culture and really, continue to cultivate that and make sure that it continues. And quite honestly, there's a little bit of pride factor as you get to see your name on the outside of the door going forward, and you spent your entire life trying to build that. So it's a great opportunity to continue to have your name as part of the community that you're involved with, and yet have your employees be owners within the company. Another benefit to an ESOP is to the employees. I will tell you that statistically, if you look at national statistics, the average 401k plan for an individual who is not part of an ESOP, so just your run-of-the-mill 401k plan, is around $45,000 at retirement. I guarantee you $45,000 in a retirement stage doesn't go a long way. The average employee balance in an ESOP plan is $250,000. So that's significantly more. I mean, if you're looking at that 6 or 7 times what you would see in a regular 401k plan. Just so the benefits to the employee are outstanding. It allows the company to attract better talent because they see that as a benefit. The average stock market can be anywhere, valuation change could be anywhere from 4 to 10%, sometimes negative. The average increase in value within an ESOP plan is somewhere between 15 and 20%, depending on your company and the ability of your company to generate profits in the future. So there's a lot of benefits to the seller. There's a lot of benefits to the employee. And it can be a significant benefit to you and to your employees that, would not be there and not be able to establish those same type of parameters with a private equity purchase or a management buyout.